Are you tired of watching your hard-earned money disappear in the stock market? Are you constantly playing catch-up with the latest investment trends and strategies? In this video, we will dive into the world of investing and uncover the 7 golden rules of investing according to one of the most successful investors of all time, Peter Lynch. With decades of experience under his belt, Lynch managed to turn a $20 million fund into a staggering $14 billion in just 13 years. So, sit back, relax, and let's learn from the master himself, Peter Lynch. Rule number 1 of Peter Lynch's 7 golden rules of investing is to know what you own and why you own it. Investing in a stock without truly understanding what the company does and what drives its success is like blindly throwing darts at a board. Sure, you might hit a bullseye occasionally, but there are more reliable strategies for long-term success. So, how do you know what you own and why you own it? Start by doing your research. Read the company's financial statements, annual reports, and news articles to understand its products or services, competitors, and growth potential. For example, let's say you're interested in Tesla. Before making decisions, research the company's financials, including revenue, net income, and debt levels. You should also understand the company's products and services, such as its electric vehicles and energy products, and how they differentiate from competitors. Moreover, you must research the regulatory landscape, as regulations around electric cars could impact the company's growth potential. Once you've researched, ask yourself why you want to invest in this company. Is it because you believe in its products and services? Does it have a competitive edge over its rivals? Understanding your motivation to invest in a particular stock can help you make informed decisions and stay committed to your strategy. Rule number 2 is don't try to time the market. It's a common mistake for investors to try and predict the stock market's movement. But the reality is that even the most experienced professionals need to time the market consistently. Trying to time the market can lead to missed opportunities, costly mistakes, and lower returns. Instead of trying to time the market, focus on the long-term potential of the companies you invest in. Invest in companies with strong fundamentals, such as a solid financial track record, a competitive advantage, and a strong management team. For example, you invested in Amazon in 2000 and held the stock until today. Despite the ups and downs of the market over the past 20 years, your investment would have grown by over 20,000%. This demonstrates the power of investing for the long term, rather than trying to time the market. Rule number 3 is to buy businesses, not stocks. When investing in the stock market, it's easy to get caught up in the daily fluctuations of stock prices. But Peter Lynch advises investors to focus on the underlying businesses behind the stocks. By investing in businesses with solid fundamentals and growth potential, investors can benefit from the company's success over the long term. For example, let's say you're interested in investing in the retail industry. Instead of buying individual stocks in companies like Macy's or JCPenney, you could invest in an exchange-traded fund that tracks the performance of the overall retail industry. This approach allows you to invest in a diversified portfolio of retail businesses rather than betting on the success of a single company. It's also important to consider the quality of the businesses you invest in. Look for companies with a competitive advantage, such as a unique product, service, or a firm brand. These businesses are more likely to succeed over the long term, providing better investment opportunities. By investing in businesses with solid financials, you can increase the likelihood of a successful investment outcome. Rule 4 of Peter Lynch's 7 golden rules of investing is to do your homework. Investing in the stock market requires more than just luck. It takes a considerable amount of research and due diligence to identify high-quality businesses with solid growth potential. Start by researching the industries you're interested in investing in, and look for trends and patterns that could impact a company's future success in that industry. For example, if you're interested in investing in the technology sector, research emerging technologies like artificial intelligence or the Internet of Things, and how they could impact the companies in that industry. Once you've identified potential businesses to invest in, dig deeper into their financials and business operations. Look for revenue growth, earnings growth, debt levels, and cash flow. You can also research the company's competitors to understand how they stack up against the competition. Keeping up with the news and current events that could impact your invested companies is also essential. For example, if a company you own has a significant product launch coming up, you'll want to stay up to date on any developments or news related to that launch. By doing your homework and staying informed, you can make informed investment decisions and stay on top of any changes or developments in the market. Rule number 5 is to invest for the long term. Investing in the stock market is a marathon, not a sprint. It's essential to have a long-term investment horizon to benefit from the power of compounding returns. When you invest for the long term, you can take advantage of the ups and downs of the market and earn significant returns over time. By holding onto your investment for years, or even decades, you allow yourself to benefit from the growth of the businesses you've invested in. Focus on investing in high-quality businesses with solid fundamentals and growth potential, and hold on to them long-term. Over time, the ups and downs of the market will even out, and you'll be left with a solid portfolio of long-term investments. Of course, it's essential to review your investments and make adjustments as necessary regularly. But overall, a long-term investment approach can help investors weather the inevitable ups and downs of the market and earn significant returns over time. Rule number 6 of Peter Lynch's 7 golden rules of investing is to ignore the market. This rule may seem counterintuitive, as it's natural to want to keep an eye on the stock market and its movements. However, Peter Lynch believed that focusing too much on short-term market fluctuations can lead to emotional decision-making and cause investors to make poor investment decisions. Instead of focusing on the market, Lynch advised investors to focus on the fundamentals of the businesses they are invested in. Investors can make informed decisions based on the business's prospects rather than short-term market movements by analyzing a company's financials, growth potential, and competitive advantages. One example is the story of the Home Depot, a home improvement retailer that Lynch invested in during the 1980s. At the time, the stock market was volatile, with wild fluctuations in stock prices. Despite this, Lynch saw the potential for the Home Depot to disrupt the home improvement industry and become a significant player in the market. He focused on the company's fundamentals rather than the market's movements and made considerable profit. Another example is Warren Buffett's famous quote, "Be fearful when others are greedy, and greedy when others are fearful." This advice highlights the importance of ignoring short-term market movements and focusing on the long-term prospects of businesses. The final rule of Peter Lynch's 7 golden rules of investing is to be patient. Investing is not a get-rich-quick scheme. Building a successful investment portfolio takes time, dedication, and patience. Many investors make the mistake of expecting immediate results from their investments and become discouraged when they don't see quick returns. However, as we discussed earlier, investing for the long term is essential to achieving significant returns in the stock market. Peter Lynch advises investors to be patient and stick with their investments, even when the market experiences short-term volatility. Patience can also help investors avoid making emotional decisions based on fear or greed, leading to poor investment decisions. One example of the power of patience in investing is the story of Warren Buffett's investment in Coca-Cola. Buffett began investing in Coca-Cola in 1988 and held on to the stock for decades, despite fluctuations in the market and occasional dips in the stock price. By 2019, Buffett's investment in Coca-Cola was worth over $20 billion, demonstrating the power of patience and long-term thinking. And there you have it, Peter Lynch's 7 golden rules of investing. Following these rules can help investors make informed decisions based on the fundamentals of businesses rather than short-term market movements or emotional reactions. Investing is a long-term game that requires patience, discipline, and dedication. Applying these rules to your investment strategy can increase your chances of success in the stock market. But don't just take our word for it. Do your research, analyze the businesses you're interested in investing in, and stay informed about market trends and news. Whether you're a beginner investor or a seasoned pro, Peter Lynch's golden rules can be a valuable guide to help you achieve your investment goals. So, why not try them and see where they can take you? Thanks for watching, and as always, happy investing.